Hi friends, welcome back to the channel. Few days ago, I saw these reports from Worm Capital on Tesla. I think it's very interesting. There are a total of 92 slides. I will just go through with you. Although the content of the report is fairly simple, but I think it brings up the most important key points with regards to why we should bullish on Tesla. Let's start. The report was prepared by Worm Capital. They call themselves value investor focused on the future. Usually Tesla is associated with high PE and high valuation, so it is interesting to see someone that call themselves as value investor and at the same time bullish on Tesla. The Tesla decade. The future is already here, it is just not very evenly distributed. William Gibson. This presentation outlines our view on the scope of a Tesla opportunity within a changing industrial landscape, Tesla competitive advantage and consistent executions as a market vanguard, a set of probable future outcomes for Tesla financial growth. Some background on us. Tesla has been our largest position for 4+ years. We have long believed that Tesla was destined to be one of the largest companies in the world based on the free cash flow and net income. This is important because regardless of how many cars they sold, if they are not able to turn it into free cash flow, it means nothing. It will only be hype. It is still early days. Our multi-year research effort into Tesla manufacturing capabilities and supply chain integration suggests that Tesla is more than 6 years ahead of any competitor. This lead is expanding. The company has massive scale today, which in our view will likely compound at significant rates going forward and outpace current consensus expectations by a wide margin. We believe that many market participants do not yet grasp the extensive data, software, manufacturing, and AI advantage that Tesla enjoys. Overall sell-side estimates of Tesla growth are, in our view, extremely low, a recipe for an epic redistribution of wealth. Hitting the inflection point. Tesla is in expansion mode. Infrastructure is being built out to sustain about 50% year-on-year growth through 2030. Operating gross and net margin should expand at a healthy rate over time. If Tesla grows at 50% rate for 8 years, its size will 25x of today's size. Our forecast of Tesla in the 2020s. Ludicrous growth mode, we anticipate 50% plus revenues CAGR, more than any company of its size and scale in history. The potential to achieve a 20 million vehicle production run rate by year-end 2030, 40% plus gross margin at scale. We believe Tesla shares could offer a 10x return by 2030 and potentially much more. Note, our 10x by 2030 valuation assumptions include Tesla current business lines. This figure does not include Tesla planned robotaxi network or real-world AI product revenue, each of which have profound upside implications to our financial models. One thing I want to highlight here is that you can make up any assumptions that you like. For example, why only 50% growth and not 40% or 60%? Why gross margin is assumed to be 40%? Their current gross margin is around 30%. Intrinsic value is a very subjective calculation, so it depends on the assumptions that you put in. The view from Mars. What is Tesla? Tesla is best described as a holding company composed of 4 distinct businesses: consumer transport, commercial transport, energy, real-world AI, or autonomy. Each of these businesses exists on a continuum, operating at various stages of cash flow and maturity, from near-term to long-term, move people, move goods, energy, real-world AI. Vertical integration is key to Tesla's long-term success. From raw materials to gigafactories, to advanced manufacturing at scale, to direct-to-consumer model plus superchargers, vehicles, energy, AI. From vehicles to data collections, software iterations, to real-world AI, and come back to AI. 2 big ideas. Vast end markets. These 4 verticals cumulatively represent over 15 trillion in addressable markets. Cars are just the start. Tesla consumer vehicles are the entry point to develop necessary cash flow to build up new and bigger business lines in the coming years. Energy storage, robotaxi software, bots, and more. From ICE to EVs, how to imagine a disruption of this magnitude. There are currently 2 billion combustion engine cars in the world, annual sales 67 million ICE vehicles, annual revenue 2.7 trillion. Auto represents 3% of overall GDP in USA. EV adoption represents the largest industrial paradigm shift of the 21st century. In 2021, electric car sales more than doubled to 6.6 million, representing close to 9% of the global car market and more than tripling their market shares from 2 years earlier. All the net growth in global car sales in 2021 came from the electric cars. Multiple factors are driving all transport towards 100% EV quickly. Lower total cost of ownership, lower depreciations and potentially appreciating characteristic via software upgrades, simplified manufacturing and maintenance processes, fewer moving parts, iPhone-like product enhancement, range anxiety no longer a concern, fast charging, energy-dense low-cost batteries, etc. What comes next? How quickly will the shift happen? Which companies will emerge triumphant? Will it be one company or many? Can the existing OEM incumbents make this transition from ICE to EV? Will they survive? Will a new crop of companies emerge? Our perspective on the Cambrian environment, worm theory. We believe the one-room hypothesis. Post-internet, customers can quickly identify the best product or service. It's a land grab environment. Companies should optimize for scale and value propositions. Winner take most. Big winners, big losers. History suggests these transitions are unkind to incumbents and underfunded upstarts. Many OEMs transitioning to EV will fail. Immense switching costs, legacy cash flow models, auto dealer networks, lack of battery supply, heavy debt load, brain drain of talent. Competition? For years, the incumbent auto OEMs have made public claims that they are pivoting to EVs and deploying significant capital to achieve those goals. OEMs increasingly look like carriage manufacturers of the early 20th century. Incumbents have not vertically integrated battery supply, software, etc. Their existing manufacturing lines could become stranded assets by 2025. There is no competition yet. Just look at the EV production volume. Tesla is leading, followed by BYD, Stellantis, Volkswagen, XPeng and NIO. Best product wins. As you can see here, Tesla Model Y and Tesla Model 3 are leading. This is months after vehicle launch. GM failed push into EVs is a sign of what's yet to come. GM production's volume, the green color is total wholesale vehicle sales and the blue is EV produced. As you can see, the EV produced started out around 23,000 in 2017 but it hasn't grown. It still starts at 22,000. The tipping point, ICE production in decline. The green is Ford, the blue one is GM and the red one is Tesla. So they expected that Tesla production will outpace Ford and GM around 2023. Our view, winner take most. Tesla is likely to dominate over time with sustaining advantages, power loss, return to scale and compounding network effects. Historical analogies, Google search, data advantage leads to better value proposition, Apple iPhone, consumer obsessions, App Store ecosystem. Tesla is 10 years ahead, especially when it comes to the manufacturing. Characterizing a Tesla lead. Tesla is growing at the fastest pace of any large manufacturing object in history. A qualitative review of Tesla mode. Advanced manufacturing at scale, battery strategy, autonomy and real-world AI training, fast charging infrastructure, global, localized productions, top intellect recruiting, direct-to-consumer business model, integrated software, and brand value. Next, we will go through each of these. Advanced manufacturing at scale. To make the best cars in the world, we design vehicles and factories from the ground up. Rewriting mass production. Ford Model T, 1913 to 1927. Rewrote manufacturing by utilizing assembly line. Production costs made the automobile a staple in American society. Reinvented transport for the next 100 years. Tesla 2017 to 2030. Reinventions of consumer vehicles and manufacturing processes. First desirable mass market electric vehicle. Totally vertically integrated and automated building process. The factory is the product. Tesla is Tesla's biggest customer. Factory construction from a first principles perspective. Materials engineering and supply chain integration. Factory robotics or machinery, constant improvement. Tesla doesn't contract out factory construction. Tesla has an in-house construction unit building out its factories. This enables a radically new and optimized manufacturing process. Historical analogy, Amazon built its own distribution centers to reinvent e-commerce logistics. Tesla designs factories like semiconductors. It makes sense to think of the factory like a chip, like an integrated circuit, combine everything together in one package, stamping out cars like Hot Wheels. Die casting is a revolution in auto manufacturing, enabling lightweight and cost-efficient production. Tesla works with Hydra, which builds customized 6,000 plus ton stamping machines to produce cars at scale. This new process could lower labor costs by 20%. Proprietary alloy reduced parts. Tesla has developed single die cast made of custom aluminum alloy, a first in autos manufacturing and inspired by engineering at SpaceX. Accretive to margins and to production efficiencies. Example, 168 fewer parts than Tesla previous process. In-house machine software, speed up response time. Tesla developed its own OS to manage nearly all its manufacturing robots with custom software. Changes can be made to its OS much faster than other OEMs can draft a proposal to send to a third-party vendor. Net result, improving margin profile. Tesla will be absolutely head and shoulders above anyone else in manufacturing. That is our goal. Tesla auto gross margin about 30% and GM EV gross margin about negative 64%. This is one of the most important slides. We can talk about all the good stuff, however, it has to be something that makes Tesla to be more competitive than others. The vertical integrations help them to speed up the improvement and also drive down the cost, and also reduce the reliance on external parties. As more activities actually happening inside Tesla, it's not just a normal car companies, and consistently improving. We are getting way better at making cars. You can see that in Giga Shanghai, you will see that even more with Berlin, and we are really changing the design of the car in order to make it more manufacturable. Battery strategy. Tesla 2030 cell production targets. So the plan is to grow from 100 gigawatt hours in 2022 to 3 trillion watt hours by 2030. Tesla planned production is literally off the charts. Tesla battery targets in context. To put in context, 3 trillion watt hours equals to production capacity for 60 million Tesla Model 3s. In context, the global vehicle market supports about 67 million new vehicles per year. Over time, we think Austin will be the biggest cell factory in the world. Cathode material sourcing. Tesla has secured multi-year materials contract at a discount given their scale. Other OEMs will continue to struggle with costs given low initial volume purchases and low profitability, which creates a negative feedback loop. Tesla dodges nickel crisis with secret deal to get supplies. People don't realize how far ahead Tesla is when it comes to securing the supply chain for raw materials and an integrated approach to battery materials. Innovative lithium sourcing. Commodity prices are prone to volatility. The best hedge is to go directly to the source. Tesla patented a novel low-cost lithium extraction technique involving sodium chloride. Tesla has secured rights to 10,000 acres of lithium clay in Nevada. Mini case study, 4680 cells. You can't do continuous motion production if you have taps. Elon Musk Battery Day 2020. Tesla has developed a new form factor which introduces tabless cells. Combined with a structural battery pack that strengthens the car itself, is a revolution in battery engineering. 4680 will speed production by 7x, enabling massive scale. Hundreds of small tweaks equals to a few profound improvements to range and cost, stacking up the benefits of Tesla vertical integration. Range increase, dollar per kilowatt hours reduction, and investment per gigawatt hours reduction. We are building our own battery cell. We think the most advanced battery cell in the world. Tesla battery strategy is flexible to multiple current and future chemistries. Diversified cathode approach, iron-based, long cycle life, nickel plus manganese, long range, and high nickel, mass sensitive. Tesla Energy, a sleeping giant. I think there's generally a lack of understanding or appreciation for the growth of Tesla Energy. In the long term, I expect Tesla Energy to be of the same or roughly the same size as Tesla automotive sector. The runway for energy is huge. 2021 segment revenue, auto 51 billion, energy 2.8 billion. We think energy CAGR will accelerate through the decade and could be generating 160 billion in net income by 2030. Truckers are being squeezed. Truckers desperately need autonomous EVs. Most truckers are independent contractors responsible for operating costs themselves. 100% plus turnover in US truck drivers. Global freight trucking industry will reach 2.7 trillion by 2026. Tesla trucking opportunity. Tesla Semi, price 180,000, fuel saving 200,000, and FSD improves safety. Fundamental constraints to EV semis is cell capacity. Tesla is best positioned to make affordable and profitable electric semis at scale. Autonomy and real-world AI. I think a very powerful sustainable advantage for us in the fleet. Nobody has the fleet. It's just a massive data advantage. The race to autonomy, to be first, scalable approach, which is using computer vision, data collection at massive scale, robust neural network training infrastructure. Tesla installed base equals to advantage. We estimate now they have over 5 billion miles of data, up from 3 billion miles in April 2020. 1.5 million plus vehicles on the road today collecting data. By end of year 2022, we expect this to increase to 3 million. 60,000 plus FSD beta tester on the road. Competitors, Comma AI, 50 million plus miles, Waymo, 20 million plus miles, and Cruise, which is only 2 million plus. So Tesla is clearly leading in terms of data collection. Data advantage is expanding. No other domestic OEMs equip vehicles with comparable data collections hardware. Tesla has a negative cost of capital to acquire marginal data. Tesla makes FSD-enabled data faster than any other OEM. So please note that Tesla driver bought the car using the FSD and helped train the AI. They don't get paid for doing so. Vertical integration enables AI side bets. Tesla built ASIC to run computer vision's neural nets at low power FSD chip. FSD chip used to develop Tesla bot. First use Tesla factory floor, total addressable market, global physical labor market. By the way, ASIC stands for Application Specific Integrated Circuit. It is integrated circuit chip customized for a particular use rather than intended for general purpose. AI training. Tesla trains its AI via in-house GPU cluster. Number 5 supercomputer in world by flops. This is a huge investment that requires free cash flow funding, engineering expertise, and real-world datasets other OEMs do not have. The goal is to develop world's best computer vision AI training supercomputer. Is Tesla creating the next NVIDIA? D1 chip. Tesla designed ASICs to train computer vision's AI. Dojo, next-gen supercomputer targeting 1 exaflops of compute power. Business optionality, AWS, Intel. So Tesla D1 chip purpose is to train the AI. Fast charging infrastructure. If Tesla supercharger network open up to you, the biggest network, your car has a higher utility to you and to a future owner. So actually the car may actually appreciate in value for anybody that is holding one now. Tesla supercharger network is a massive moat. US fast charging ports. Tesla has about 12,000 and the second largest one is Electrify America, which only has 3,000. This is 4 times larger. The market underappreciates supercharger value. 30,000 plus first-party chargers globally, no other OEMs come close. The supercharger network enhances the Tesla value propositions. Revenues from the third parties can be accretive in the out years. Tesla supercharger, potentially a spin-out from Tesla by 2030. Localized production. Tesla is a dominant global brand. Tesla Model 3 dominates EV sales in Europe. Tesla vehicle sales quarterly deliveries increased significantly over the past quarters. Tesla's China sales have grown to nearly half the size of the company's US sales. The footprint is expanding at enormous scale. Just look at how big is Giga Texas and Giga Berlin, which are the 2 latest gigafactories that has been completed this year. Top intellect recruiting. Engineering students rank Tesla as one of the most desirable US companies to work for. The first one is Tesla, followed by SpaceX, Lockheed Martin, and the rest. Direct-to-consumer business model. The dealership model is over. Typical OEM distribution costs are 3,000 to 4,000 higher than Tesla. 75% of the Tesla Model 3 owners in 2019 Bloomberg survey say that they were very satisfied with Tesla D2C delivery relative to a traditional dealership model. Tesla get rid of the dealership model and it sells direct to the customers. This is a mode that many people may not appreciate enough. Basically, they have removed the middle persons to bring down the cost. Cost advantages is considered one of the economic modes. I think Tesla also has other economic modes like high switching costs, network effect, intangible assets, and efficient scale. Integrated software. The user experience is simply better, like going from BlackBerry to iPhone. Just look at the photo. BMW infotainment, Garmin's navigation, 2012 music interface reliance on iPhone for superior experience. Whereas for Tesla Model S infotainment, powerful enough for console games, high definition navigations, video player, streaming. Supercharger network integrated into the navigation. Tesla in-car console is like the early days of Apple App Store. Tesla App Store likely coming. With autonomy, Tesla will benefit from attention economy upside. Apple App Store grossed more than 85 billion in 2021 based on a 30% commission rate. Business optionality including gaming platform. This is showing Tesla hiring for video games engineer, infotainment software. Integrated software maximizes product utility across Tesla businesses. Energy management software integrated with battery storage systems, useful to maximize value of stored electricity. Distributed utility business optionality, for example virtual power plants. Competitors, STEM Energy, and Fluence. Software could make Tesla a massive power utility. Powerwalls can operate as a giant distributed utility. This is profound. Brand value. Tesla most valuable intangible assets. Hint, it is not Bitcoin. Global brand with $0 advertising spend. Tesla net promoter score is an astounding 98. Tesla generates massive publicity by word of mouth. 2021 advertising spends as percentage of operating income. You can see that Ford is 69%, GM is 35%, and Tesla 0. Polarizing design leads to product virality. Data shows over 3 million Tesla Cybertrucks orders, and it is not surprising. Tesla dominates pop culture. Financial projections. We think that Tesla growth could shock Wall Street for several years. We think Tesla will likely grow production at least 50% per annum on average through 2030. Right now, Wall Street expect mean reversions, less than 20% annualized growth. We believe Tesla shares offer the best risk-reward investment opportunity in the market today. A convergence of accelerated growth, expanding margins, new products, and recurring software revenue could drive at least a 10x returns in Tesla shares by 2030, and potentially much higher. Top-line revenue estimates consensus vs VOM. The best investment typically arise out of extreme forecasting arbitrage scenarios. This is a huge one. Note, this estimate does not include robotaxi revenue, so their estimate is much higher than the consensus. Conclusion: This presentation primarily outlined our qualitative review of Tesla's current businesses. It did not include a quantitative perspective on our valuation approach to Tesla Robotaxi network and other expanded use case of artificial intelligence integrated into new business lines. Note, factoring in these core options, especially Robotaxi network, will result in some profound implications for Tesla financials beyond what we have laid out here. Qualified prospective investor and current Worm Capital partners are welcome to get in touch for a more detailed quantitative perspective. Alright, that's all the content in this report. Thanks to Worm Capital for sharing with us their investment thesis on Tesla. I think it summarized all the important key points on why we should bullish on Tesla. I hope that one day they will release their quantitative research on Tesla to the public. Alright, thanks for watching and see you in the next one. Cheers!